Next, we'll discuss the formation of a partnership. This is when two or more people, they get together, they say, hey, let's form a partnership. They each have to maybe put in money or different assets into the business to get it going. And they'll have to do journal entries for this. The first step is that each partner will invest assets at agreed upon value, basically the fair market value of what the assets are worth. For example, maybe if I had a business and someone I knew also had a business and we wanted to combine both of our sole proprietorships into one partnership, we might be bringing over our assets that we already have on our books into this new partnership. If something was worth a specific dollar amount on my books, it does not mean that same value is carrying over to the partnership. All assets going into the partnership will be reassessed for the fair market value. Also, each partner will have their own journal entry that you're doing. We are not combining all the partners into one journal entry. Each one will be done separate. Assets have a debit balance. Therefore, the new journal entry will have all assets listed with a debit balance. This is the journal entry for the partnership. If the partnership is getting all these assets, then they will be debits. For example, I just listed all the assets here in parentheses to show you would put the name of the asset in. If I contributed cash or a building and equipment and some accounts receivable I had, I would list them all right here. All of the assets you list as a debit because that's its normal balance. I could also carry over some liabilities. For instance, if I put a building into the business, there'll be an asset for building, but I might have a mortgage on that building. Therefore, that liability will also carry over. If I carried over accounts receivable, I might have allowance for doubtful accounts, all of the bad debts I think I will have. That also normally has a credit balance. Anything you're bringing to the business, into the new partnership, you want to keep it as the normal balance. If it's an asset, it'll have a debit balance. If it's a liability, it will have a credit balance. The last step is to total all this up. You want to total it up to see the value of this investment from the partner. Assets will increase the value of the investment and liabilities will decrease the value of the investment. Some partners might not even contribute liabilities to the business, therefore it would only be the total of all the assets. Basically, you want to add up the assets but subtract anything on the credit side. That would give us the partner's capital. You would use your last name. If it was me, it would be Kroeger, capital, and the value of my investment. We need to keep all of the different partners separated to know what the value of each of their investments are. I would do this journal entry for each partner that we have. Let's do an example. This is on your classwork. This is problem number 1. On January 1st, Michael Scott and Pam Beasley organized a partnership called the Michael J. Scott Paper Company. Michael's initial investment consists of $18,000 cash, a building with a fair market value of $80,000, and a note payable of $25,000. That's the first partner right there. The second partner, Pam's initial investment is cash of $31,000. We need to record Michael's investment and Pam's investment. Remember, we're going to be doing 2 separate journal entries, one for Michael and one for Pam. First, let's input Michael's investment. The date is January 1st. Take a moment to think of all the items that Michael Scott has invested into the business. What are the assets? His assets would be the cash and the building. We're going to put these items in. First, cash of $18,000. Next, Michael contributed a building, and we're going to use the fair market value of $80,000. Building, $80,000. These are assets, therefore they will be debits. if there were two values for the building, for instance, a value to Michael and then the fair market value, we would always go with the fair market value. What else has Michael contributed to the business? A note payable. A payable would be a liability. What side would this be on? It would be on the credit side. This reduces the investment because it's a debt to the business. The assets increase Michael's investment, but the liabilities will decrease it, offset it. Now we have to put in what Michael's investment is worth. The account name would be M. Scott Capital for Michael Scott, so we know that this account is his. To find the value, we total up all the assets, but then subtract the credit that offsets it. $18,000 cash plus the $80,000 building minus the $25,000 note would be $73,000. That would be the investment for Michael. That's what everything is worth combined together. Next, we'll do Pam's investment. Remember, it's a second journal entry. Take a moment to think what this journal entry would be. It's a little bit easier than Michael's. It would be cash of $31,000 she contributed, and that's all. Therefore, her capital account, P. Beasley Capital, would be the total of $31,000. That's all.